I need y'all to buckle up for this one. Today we're going to be taking it step by step, fam, on how to create a zero DTE options algo trading bot using Alpaca. So this is going to be our 8th edition in our vibe coding session. So if you haven't already, go ahead and smash that like and subscribe button. I'm creative, and here at Creative Coder, our aim is to be able to create different algo trading strategies, right? Being able to show y'all live backtests, being able to infuse machine learning in there, right? And different other coding projects that I may have that I want to share with y'all. Now, I've only been doing this since about April of last year, so I still consider myself a noob in this, but I just want to show y'all my process, right? Such that we can all learn together, right? Each one teach one type. Now, before we actually get into this, I want to show y'all like how I actually go through being able to create a strategy, right? Yes, at first you're going to need the idea, but we're also going to be going over back testing the strategy, right? What is a back test? A back test is being able to take your strategy, right? And a strategy because could be something as simple as, oh, I'm going to buy low and sell high, right? Or it could be something as simple as I'm going to wait for the first 5-minute orb, right? The opening range breakout. Then I'm going to use ICC, which is the initiation, confirmation, continuation, right? In order to look at my setup for the actual chart, right? So there's many ways that we can create or define a strategy. And what we're going to be doing here is creating a strategy, being able to back test it, and a back test is being able to drop your strategy in a time machine and seeing how well it does on past data. Now, the rule of thought, or the school of thought, excuse me, is that if it does well in the past, then there's a high likelihood that it'll do well in the future. And then the next step, what we're going to be looking at, is to see if we need to add any machine learning, right, to maybe able to make this strategy a little bit better. Now, the way I use machine learning is a little bit different than others. Now, when I first started with machine learning, like everybody else, I wanted to use it to predict price, right? But that's one of the novice ways of doing it. What I found is being able to use machine learning for portfolio management, right? Regime prediction is a little bit more better suited for it than just flat out predict the price, right? Or just being able to understand, is this contract going to go up or down, right? So not necessarily as binary conditions what we're looking for, but I think it's a little bit better than just picking the price, right? Then the next thing we're going to do is being able to do our walk forward validation, and all that means is that remember, back testing it, we're going to be back testing it from 23 and 24. And maybe 22, right? So 22 is going to be our bear year, 23 is going to be our hybrid year, a little bit of a bear, a little bit of a bull, then 24 is going to be our straight bull year, right? And we're going to be using 2025 to walk forward, right? And I'm going to hold out 2025 because we're going to be using it to walk forward, meaning that I don't want to make sure that we're not overfitting. I'm saying a lot of words. Let's go ahead and write this down. So I want to make sure that we're not overfitting our strategy for any particular year. So what is overfitting? Overfitting is memorizing test answers to a test. Okay, let me make this a bit bigger. Pause. Memorizing test answers for an upcoming exam, right? So that's just an analogy that I like to use for overfitting, right? So what we don't want is overfitting. Another thing that we don't want is being able to introduce bias, right? Bias for me is being able to make sure that the strat is agnostic as possible, right? That it could perform, the strategy can perform in multiple conditions, whether it is a bear or bull or ranging markets, right? And we all know that bear market equals we think the market is going down, and then bull market equals we think the market is going up, right? And then a ranging market, ranging is market going sideways or stuck in a box. So let me show y'all a couple of examples, right? So what I'm going to do is pull up QQQ and QQQ is going to be the top 100 tech companies within the NASDAQ, right? So for those that aren't familiar with QQQ, let me pull up some of their holdings, fam, so you can proper understand them. So let's go pull up QQQ holdings, and QQQ is from Invesco. Invesco is just another brokerage house that's out there. Okay, prospectus. Okay, holdings, beautiful. That's out there that created QQQ. QQQ started in 1999, 98 at the height of the bubble, and SPY, the S&P 500, the top 500 companies within the New York Stock Exchange, I think started in 91. About a full 8, almost 10 years later, that's when QQQ popped around. When it first started, it crashed, right? Because again, you got to think about it. It started at the height of the bubble, right? And it took about 15 years in order for it to recover. Now, QQQ now is one of the best ET. Now, one thing I want to say is that this is not financial advice. If you do seek financial advice, please make sure you talk to a certified financial planner. This is merely educational, fam. Now, QQQ has become one of the top ETFs, right, when it comes to being able to understand the overall direction of the tech sector, right? So being able to understand some of their holdings, we have NVIDIA. We all know that NVIDIA, Apple, Microsoft, Amazon, Micron. This is Google. I don't know why they call themselves Alphabet Class A. Then we have Tesla, AMD, or Advanced Micro Devices. This is YouTube. How ironic. Then we have Broadcom. These are just some of the top 10 holdings within QQQ. Right now, I want to talk about ranging bull and bear market. So I have a couple of great examples that I can show y'all here, right? So whenever you see a green candle like you're seeing right here, this is going to let us know that we see the bulls or the buyers in charge, right? Now this green candle is pushing up, as you're seeing indicated here, excuse me. So this is a little bit of a bull run. Now, whenever you see a red candle indicated here, this is the bears or the sellers. Their main aim is to be able to push the price down, right? Now, another thing that you're noticing is that we also have the Bollinger Bands and support and resistance line. So the resistance is going to be the highest highs, and then the support is going to be the lowest lows. Then we also have the Bollinger Bands, right? The Bollinger Bands is going to let me just see volatility play out in real markets, right? So what we want to be able to create is a strategy, right, that can trade QQQ. And again, QQQ equals the top 100 tech companies within the NASDAQ. And what is the NASDAQ? NASDAQ equals the cool version, or excuse me, the tech version of the NYSE. So NYSE is the New York Stock Exchange, right? So the New York Stock Exchange came first. New York Stock Exchange is like the granddad, right? And the NASDAQ is what happened. I think NASDAQ came late 80s, early 90s, maybe a little bit before. And they're mainly tech, right? Meaning that whenever you want to buy a buy or sell order, right, you're going to submit that via computers, right? Whereas the New York Stock Exchange, you can still submit it on the floor, right? So what we want to do is create a strategy that's going to trade QQQ, but it's going to trade QQQ 0 DTE options. Now we have a lot that we just brought up here. So 0 DTE, these are 0 days to expiration option contracts. So in layman terms, these are option contracts that expire the same day, fam. Same day. All right, and the reason I like 0 DT now, there are different types of option contracts, right? We have our weeklies, right? Monthly. Then we also have daily. And let's just stick there. I'm forgetting the L. There you go. Stop being weak. All right. So what we're going to be trading is dailies, right? Because why wait until every Friday? And these expire every Friday, the last Friday of the month. And then dailies, of course, expire daily, right? So what we're going to be doing, and the reason I chose 0 DTE, right, is because why am I going to trade an option that I have to wait until Friday to get paid? Why do I going to trade an option that I have to wait until? Now that's if you take it to expiration, right? Now when it comes to options, there's few things that I want us to be able to understand when it comes to options, right? So options for me just equals leverage. Leverage. There we go. And why do I say that? Is because one option contract equals 100 shares, right? So let's say if I wanted to get into QQQ, right? QQQ is currently, and this is after hours when I'm recording this. QQQ is currently trading at 717.50, right? So if I wanted to buy 100 shares of QQQ, that would be 100 times 717.54. So you're looking at almost 771K, right? For those 100 shares. Or what we can do is buy an option, right? So for those same 100 shares, I can buy one call, and call equals bullish, or one put contract and put equals bearish, right? Such that we can be able to get into that same contract, right? But for less the money. So here's an example, right? So let's say we have one option contract. Remember, for every one option contract is one option contract equals 100 shares, right? So this is how an option contract is going to be written. C is going to be for calls, right? And then we're going to have the strike, and the strike is going to be where we think the option contract is going to land, right? So strike equals where we believe the option contract will land at the end of the expiration, right? So here's how it's going to look. So we're going to have C is for call, right? Then 720 is going to be the strike price. Then what we're going to have is the cost of it, right? So that cost is going to be represented in premium, right? So that premium, so let's say for an example, is going to be 1.20, right? So that 120 for 720, let's just do 717 so we can be numbers to numbers, right? The reason I'm doing 717 is because that's the number of shares that I wanted for a QQQ, right? But it's going to cost me 71K for that. But let's say if I do it as an option, that option call, because I'm bullish on the market, 717 is going to be the strike price. And this is the price that I think QQQ is going to be trading at the end of the expiration, right? Then what you're going to have is the we have the right, we have the strike, we have the premium. Now we're going to have the delta, right? And what delta measures is that, so delta equals for every $1 change in the stock price, the option contract will reflect that change. Reflect that change. Come on. Reflect that change. All right. For an example, so let's say we have delta that is 0.20. Oh, you know what delta also tells you? Delta also lets us know the probability of profit, right? That's going to make more sense here. So let's say we have a delta of 0.20, right? So that delta lets me know two things. All right, so for every $1 movement, now remember there's 100 shares, right? So for every $1 movement, this option contract will move $20, right? Now, why is it $20? Is because for every 100, one option contract equals 100 shares, right? So that 100 times 0.2 equals $20. So that's how we got that $20 here, right? And what it also lets us know is probability of profit, right? So a delta of 0.20 is going to lets us know that there is a 20% chance that the option contract will expire in ITM, right? Now, ITM talks about moneyness, right? Now there's ITM, there's ATM, and there's OTM, right? Now, when you first are buying your option contracts, you want them to either be ATM or OTM, right? ATM is going to be at the money. OTM is going to be out of the money, right? And then ITM is going to be in the money. So let me show you. I should really put this here. All right, let me put this up here so we can have our notes. QQQ, QQQ, beautiful. Just put you there so you don't, I'm not running into you down here. Pause. All right, let me delete you. Listen to me. There we go. All right, so let's talk about moneyness now, right? And come on, fam. Come on, fam. Holy cow, fam. Are you not listening to me? Give me 1 second, y'all. Hold on. I just had a little technical difficulties here that I had to fix. All right, we're Gucci. Bet. All right, so now we're going to talk about moneyness, right? So, and I know that's kind of spelled wrong. I think they want an I. Whatever, just put moneyness, right? Because this is going to make sense here. So let's say we have QQQ, right? QQQ stock price is at, and this is going to make sense in a little bit. QQQ stock price is at 717.54, right? So QQQ stock price, right? So whenever we're buying an option, we are going to buy either a call or a put option, right? So remember, call equals bullish equals we think the market is going up, right? And then we have puts equals bearish equals we think the market, come on, think the market is going down. All right. So when it comes to moneyness, right? So let's say we have our strike price. Remember, strike equals the price we think that the underlying stock will move to once the option contract expires, right? So let's say, so 717 is the current price right now, fam, right? So 717 is going to go in the middle, right? So if we go to 718, 719, 720, right? Oh, my fault. Let's come back here. Then we're going to go 716, 715, 714. That's going to make the point. All right, bet, right? So for our moneyness, right, this is going to be the current price of QQQ. So the current price of QQQ is going to be ITM, right? So ITM is going to be in the money, meaning you are making money when the price goes here. Bet. All right, so whenever you have an ITM contract, you're already making the money, right? Reason you're already making the money is because there's that intrinsic and extrinsic value. Now, ITM already has the intrinsic value, right? Now, ATM has sometimes intrinsic value, but not that much, but OTM doesn't have intrinsic value. It's all extrinsic, right? So we have 717, that's going to be ITM. And then our 718 is going to be ATM, which is going to be at the money. We need the price to move here before we start making money, right? And then I'll still consider 719 to be ATM. Now, for me in my house, and everybody has a different school of thought here, right? Me in my house, I say 2 or more levels to be OTM, right? And OTM is going to be out of the money, right? And out of the money, or OTM, are Lotto ticket style option contracts. What do I mean, right? It takes a big or substantial, let me put that, substantial price movement in order for these option contracts to make money, and then go to either ATM or ITM, right? Substantial. I still didn't spell that right. All right. Can I spell substantial right? Nope. Substantial. There we go. Substantial. Beautiful. Substantial price movement in order for it to make money, right? Now, we just talked about this being a bullish move, right? So from 717 and everything going up, we talked about it being a bullish move. So these will be call contracts that are in the money, at the money, or out of the money, right? Now here, remember 717. Now 716 is going to be ITM, right? 7, I should really go down to 713, 712. And then this is going to be ATM. I would still consider this ATM. And then once we start getting to the 713s, this is OTM and OTM, right? Same principle. It works for when we explained it up here, but just different how it moves down here. We got it? All right, beautiful. So now we understand moneyness. We understand options. We understand when I say, all right, bet we're in a bullish market, right? What that means is that we see the price trending up. When I say that we are in, let me see if I can find a nice little, okay, here we go. When I say that we are in a bearish market, right, we see the price trending down, right here, right? Bullish market, bearish market, bullish market, bearish market. The price is touching resistance levels, means the price is touching higher highs. The price is touching support levels, means the price is touching lower lows, right? All right, bet. So what you are able to understand after this video, you understand how options work. 0 DTE options, right? Calls versus puts. What you also understand is moneyness and bulls versus bears, right? So in the next video, what we're going to be doing is picking up where we left off here so we can continue to being able to make our algo strat, right? I don't want to make this video too long is because I know these are a lot of new terms that we're understanding and going through, but this enables us to be able to keep building on that foundation, right? Like I need y'all to keep coming back. I need y'all to keep being able to follow us because this is great work that we're putting out here. So if you do have any comments or concerns, go ahead and drop it in the comments. I need you to go ahead and smash that like and subscribe button. It is your boy Creative, and I'll be back at it again with another episode.